We are standing at a critical moment in financial history, staring at a number that not too long ago was pure science fiction: $2 trillion. Now, this isn't just some big number on a screen. It's a mathematical event horizon. It's a point of no return that is forcing every single investor to choose between two completely different futures. One is a total system collapse, and the other is a violent repricing of everything we think we know about money and value.
So here's how we're going to break this all down. First, we're going to look at a shock from the past that really set the stage for everything that's happening today. Then we'll face that $2 trillion cliff head on. We'll explore the two possible roads from there: collapse or repricing. We'll see where the smart money is quietly moving right now. And finally, we'll understand why the old rulebook for investing is, well, officially broken.
You know, to really understand the psychological wall that investors are hitting right now in 2026, we actually have to go back, way back, more than 50 years, to a single decision that completely changed the very nature of money, forever.
The date is August 15th, 1971. President Nixon gets on TV and announces to the world that the US dollar can no longer be swapped for gold. Just like that, with a few words, the anchor of the entire global monetary system was gone, and a brand new, massive experiment with paper or fiat currency began. Okay, so picture this. The very next morning, a young clerk named Ray Dalio, the guy who would later build the biggest hedge fund in the world, is standing on the floor of the New York Stock Exchange. And he is braced for absolute chaos. I mean, the logic was simple, right? If the money itself is fundamentally broken, if it's no longer backed by anything real, then of course the market that prices everything in that money must collapse. He felt this deep emotional shock, a gut certainty that it was all over. Except the market didn't crash. It went on a tear. It soared. And in that moment, Dalio learned this incredibly painful, counterintuitive lesson. When you devalue the money, the price of assets measured in that money has to go up, at least in name. And that emotional shock, that psychological trap he fell into, it's the exact same one investors are facing today, only the stakes are just astronomically higher. So let's fast forward. Let's see how that 1971 experiment has played out, because it's led us to right now, to what many are calling a mathematical point of no return, and it's defined by one single mind-boggling number: $2 trillion. As of early 2026, that's the annualized interest payment on the U.S. national debt. We throw the word trillion around so much these days, it's kind of lost its sting. So let's try to put this into a perspective you can actually feel. Think about this. This one line item, just paying the interest on money we've already borrowed, is now bigger than the entire U.S. defense budget. It's bigger than the budget for Social Security. This has become the government's single largest expense, and it buys us absolutely nothing. No roads, no schools, no healthcare, just interest on yesterday's spending. So how in the world did we get here so fast? It's something called the Refinancing Cliff. See, for more than a decade, the government borrowed trillions of dollars at almost 0% interest. But that debt, those bonds, they have an expiration date, and they're expiring now. To pay them off, we have to borrow new money at today's much higher interest rates. So the cost to carry the exact same amount of debt has just exploded. This isn't a political debate, it's just math. It's an avalanche that's already started moving down the mountain.
And this is the most crucial point to understand. This isn't a normal business cycle. This isn't an up and down thing. This is a one-way geological event. It's what some call systemic liquefaction. It's like an earthquake, so powerful it causes the solid ground under your feet to turn into quicksand. The very foundation of the monetary system is dissolving because the cost to just maintain it has become unsustainable. It's a structural failure in progress.
And that brings us to the big debate. The math is what it is, nobody denies it, but what happens next, well, that's where the story splits into two very different, competing visions of the future. This is it. This is the question that every single person with a savings account or a 401k has to answer for themselves. When we go over this mathematical cliff, what does the world actually look like on the other side?
So on one side, you have the liquefaction camp. They believe the system is caught in a death spiral. Faith just evaporates. People stampede for the exits, selling all their paper assets, stocks, bonds, you name it. The whole system just structurally collapses. But on the other side, you've got the repricing argument, the Ray Dalio 1971 lesson. In this version, the system saves itself by sacrificing the currency. They just print whatever they need, causing a violent melt-up in the price of assets.
Yeah, the S&P 500 might double, but a loaf of bread quadruples. The real crash isn't in the price, it's in your purchasing power.
So, while all the experts are arguing about which future is coming, what are the most sophisticated investors and even central banks actually doing? They're not going on TV and panicking. No, they are moving in silence. And where they're moving their money is probably the most important signal you could ask for. First things first, they are getting out of what is now being called the 60-40 death trap. For what, 50 years, the advice has been simple: 60% stocks, 40% bonds. But in a world where the government must devalue the currency to pay its interest bill, what is a bond? It's just a promise to be paid back later in that same devalued currency. It has become a guaranteed way to lose your purchasing power.
So, where is that capital fleeing to? It's making a quiet migration towards something called strategic sovereignty. This basically means owning real, tangible stuff that exists outside the promises and liabilities of the banking system. We're talking about physical gold, the kind you can actually hold in your hand, not a paper ETF. We're talking about productive farmland that grows the food people need to eat. Strategic energy resources. They are buying things you can't just print into existence. And look, this isn't happening in a vacuum. There is this huge parallel pressure coming from the outside. The BRICS Plus nations are actively building their own trade and settlement network, one that's backed by real stuff like commodities and gold. Now, this isn't just symbolic. It creates a real, viable alternative to the dollar for global trade. And that just adds more fuel to this fire.
Okay, let's pull all this together, because it all points to one single massive takeaway. It doesn't matter if you believe in the total collapse scenario or the violent repricing scenario. Either way, one thing is now crystal clear. The era of passive investing is over. Done. Finished. This is the one thing that both sides of the debate totally agree on. The old strategy of just putting your money in an index fund, closing your eyes and hoping for the best, that is not a viable plan anymore. The very ground is shifting beneath our feet, and the next few years are going to demand active, aware, and prepared investors. So that leaves us with the final question, the one that this $2 trillion cliff is forcing all of us to ask ourselves. In a world that is built on an ever-expanding ocean of paper promises, what actually holds real weight? The answer to that question will almost certainly define who builds and who loses wealth in the next generation. And the time to figure out your answer is running out fast.